Welcome to this video, which is about the business cycle. Hello, I'm Peter Martin with Trading 212. Now, in this series of videos about investing, we'd previously said that long-term investing is not about negotiating short-term fluctuations in the stock market. But as investors, we do need to be aware of overarching trends that affect the economy and, as a consequence, the stock market. Now, you may well be aware that the stock market has been enjoying an extended bull run, going all the way back to the financial crisis, and that during the financial crisis, a period of economic contraction, the stock market suffered steep falls. Now, if you go back through the economic history of the UK and the US, you'll notice that we have these periods of economic expansion that are separated by downturns in the economy, periods of economic contraction, and this is what's called the business cycle. Now, in the US, when the business cycle changes from downturns to periods of expansion, is defined by an organization called the National Bureau of Economic Research, the NBER, and in fact it was the NBER who gave us the standard definition of the business cycle, which is at the core of modern economic theory. I'm just going to read to you the definition of the business cycle, and this was defined by a couple of economists at the NBER called Arthur Burns and Wesley Mitchell, and they said that the business cycle is a type of fluctuation found in the aggregate economic activity of nations that organize their work mainly in business enterprises. A cycle consists of expansions occurring at about the same time in many economic activities, followed by similarly general recessions, contractions, and revivals, which merge into the expansion phase of the next cycle. Now, no two business cycles are the same. So although we call it the business cycle, it doesn't sort of regularly or periodically just fluctuate. Periods of economic expansion from trough to peak, or periods of contraction from peak to trough, can vary widely. And why should we care so much about the business cycle? Well, in boom times, it is easier for companies to generate higher earnings. If companies have got higher earnings, it should drive their share price higher. Now, while it's possible to have corrections in the stock market or big downturns in the stock market outside of recessions, and the stock market itself is actually considered a leading indicator of the business cycle, if we were to go back and look at historical data, we can see that there is obviously a relationship between the business cycle and the stock market. On your screen now, there is a chart of the Dow Jones Industrial Average over the last 30 years, adjusted for inflation and plotted on a logarithmic scale, which makes it easier to make comparisons over the decades. Now, we can see over the last 30 years that the big bull runs have coincided with expansionary phases, while declines have coincided with economic downturns. Perhaps there's not too much of a surprise in that. Now, the usual benchmark for the business cycle is GDP, the broadest, most comprehensive overall gauge of economic health. But there are other indicators that we can use to help us gain a feel for what's going on with the business cycle. And these are usually arranged into three broad categories, the first of which are leading indicators. And these are economic indicators of which it is thought that they have predictive accuracy with regards to changes occurring in the business cycle. The second are coincident indicators, indicators that show changes as these changes are occurring in the business cycle. And the final group are lagging indicators. They show a change after the change has occurred in the business cycle, and those are used to confirm that those changes have occurred. Now, as investors interested in the stock market, which tends to just start to move ahead of changes in the business cycle, we might be more interested in the leading indicators, just to give us an early warning of potential changes in the business cycle. And so you might find it useful to know that there is actually a composite index that is put together by the conference board that is comprised of a number of leading indicators. And this is called the LEI, the Index of Leading Indicators. And it contains such indicators as jobless claims, as building permits, and new orders for manufacturing in non-defense capital goods. Well, that's just a quick look at the business cycle. I hope you enjoyed the video. If you did, please hit the thumbs up button and give us a like. Or if you've got any feedback, why not send us a message in the comments section. We do read through every comment that comes in there. Now, we will be adding more of these videos about investing on a regular basis. If you hit the alarm bell icon, then you'll get a notification the next time we upload a new video to YouTube. But that's all for this time from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.